thank you for coming to our last Financial Literacy Lunch and Learn Series event for this quarter. We have several more planned for next quarter. I don't know if you guys know this, but April is a financial literacy month. How many of you guys knew that? Okay, well, now you guys know. Okay, yes, it is a financial literacy month, and we have many things planned for you. We have an event planned for you every single week. Some of the topics, we're going to do another Vital Reality event, second week of April. And the first week, we're going to be talking about Banking 101. How many of you guys know how to open up a bank account? How many of you guys know the difference between a savings, like a credit union versus a regional bank or a national bank? Oh, great. We have one person raising their hand. Well, we're going to go over all of those basics on how to do that, and also how to utilize bank to actually make it work for you. We're also going to be having somebody, we're going to have like an interview with an expert. This is going to be led by a former bank executive. We're going to go through home buying 101. What kind of things do you need to do to prepare yourself before actually going out to actually buy a home? And there's one more event, which is going to be presented by one of our panelists here, Ali, and Troy is going to be introducing a little bit later on. She's going to be actually putting together a 2-hour session on financial planning 101, and that will be on April 20th. And so I just make sure you mark your calendar for that, okay? So having said that, it's really exciting having all of you guys here today. As you guys know, we hold these workshops for you. They're completely free. And we hope that you guys will be more, encouraged to actually learn more about your personal finances and how to manage your money. And so that's what the Financial Literacy Initiative is doing. But we also have a wealth creation side to financial wellness. And I don't know if you guys know this, but we have a new finance lab on the 3rd floor. How many of you guys knew that? And so basically, it's a trading room. And so we have Bloomberg terminals, which has a whole host of financial data already in there. And so therefore, we have, if you go to our website, it tells you when the lab open hours are. It's going to be Monday, Wednesday, Fridays I believe from 8 a.m. to 5 p.m. unless we're holding any events in there. And those are also noted on the website as well. So I encourage you to go to our website. And so if you go to Milgar School of Business, you click on one of the menu items that says Centers. And then there, you're going to see Center for Financial Wellness, and you can see what those lab hours are there as well. And so to get things started, I want to introduce Dr. Dean Althoff. He's the Dean of Milgar School of Business and also the Professor of Marketing. Okay, here we go.
Thank you very much, Yusuk, and welcome. It's so nice to see everyone. And I'm super excited about today's panel discussion, which is about managing money during uncertain times. I'm certainly excited about it. And earlier I was having a conversation with the Chancellor, and she's excited about it. And she wishes that she could have come, but there are lots of things going on. I'd like to start off with introducing our moderator, Troy Rucker. Troy spent 22 years in institutional asset management at Russell Investments, ultimately serving 5 years as the Managing Director, President, and CEO of Russell Investments Implementation Services. During his tenure at Russell Investments, Troy was one of the chief architects and leaders of Russell's global implementation services business. He held numerous roles focused on business growth and daily operations, advancing from technical analyst to portfolio manager, and then senior leadership roles as chief operating officer, and then as managing director. So Troy is definitely very accomplished, and currently what Troy is doing is he's a co-owner of a performance footwear and outdoor gear store. It's a customer-focused retail store specializing in premium brand, recreational footwear, apparel, and gear. Troy enjoys leveraging his skill set in business growth and development and operational efficiency to help lead this thriving business. So that's Troy. What else is beautiful for this panel is that all three of these panelists serve on the Milgar School Executive Council. Now that's the board of business leaders who serve as my advisor. Okay, so all three of them are my advisors. They give me advice. We meet every quarter and we discuss of how we can provide better services to students. They not only provide advice, they're given their time, they're given their money, they're given their connections. So they really are our champions and our advocates in the community. So Don Clark, Ali, as well as Troy. I don't want to take too much time, but I do want to mention that today is International Women's Day. And I do want to recognize that. I want to recognize all the women in today's audience here, all our students, our staff, our faculty. Inclusiveness is a way of life at the Milgard School. 9 out of 14 members in my leadership team. So, we have directors, associate deans, and program directors, etc., center directors. 9 out of 14 people in my team are women. So women are running the school, and they are actually also running me. So I just want to give greetings to all women in the audience today and recognize that it's International Women's Day. With that, over to you, Troy.
Excellent. Well, thank you, Dean Merchant. I appreciate the kind words. Welcome, everybody. We definitely appreciate you joining us today and in what we hope to be an informative, action-oriented discussion. As Dean mentioned, my name is Troy Rucker. I'm excited to be joined by 2 industry experts, Kemp and Don Clark. And it seems that wherever you look, I mean, even just looking at the slide on the screen, whether it be online, on news apps, social media, we're just bombarded with a lot of negative noise about fear, doubt, and uncertainty, of a pending recession, and a constant reminder of just inflation being at historic levels. It can be confusing, it can be scary, and I'll be the first to admit it's rather unsettling. We were just talking about this at lunch, actually. And so today, what we want to do is bypass a bit of the formal definitions and speculation and provide just some real world talk of what you can do to weather any potential storm. More so, we want to arm you with actionable steps that you can take in any market environment to help set yourself up for success in your financial wellness. So, quick intros of our panelists today. First, Kemp. She is the CEO and owner of a regional RIA, Financial Insights Wealth Management. And under Ali's leadership, the firm has been recognized as one of the fastest growing RIAs in the nation. Also a huge accomplishment in 2022. Ali was recognized as one of the 40 under 40 by Investment News Magazine, and she has served multiple roles at the firm as Chief Compliance Officer and also holds the CFP designation. She currently leads a team of 17 staff and is working to progress the industry towards ethical business leadership, inclusive team dynamics, and creating a firm that serves all of its stakeholders. So welcome, Ali. Absolutely. And Don Clark. Don is the president and CEO of Sound Credit Union. We were talking at lunch. I'd been a longtime member of Sound Credit Union from back, I think in my high school days, actually. His overall focus is helping to build stronger communities through easily accessible financial tools and resources. And externally, Don is responsible for making sure that the members receive the help they need in order to achieve their financial goals. Internally, his focus is on strategy, driving the business. He's ensuring that the Sound team members have the tools and resources to better serve their members, while also ensuring that Sound remains financially strong so they can continue to deliver quality service to their stakeholders. So welcome both panelists. To start, I just wanted to outline really 3 tenets that I look at around managing your finances. Our experts will dig into much more detail and really add some meat to the bones around this, but just generally speaking, I like to try to keep things in 3s, keep it fairly basic, and you can go detailed from there. The first is what gets measured gets managed. And what I mean by that is you have to look at the metrics and measure what you're doing. And specifically, creating a budget so you can track your income and expenses. And I think that is just the absolute first step. You have to know what's going on with your finances in order to be able to better manage them. You have to measure to be able to manage. Second is start early. We've had multiple discussions about, sometimes folks thinking, well, I don't have enough money to start investing. I don't have enough money to have a meaningful impact on increasing my savings. And I would just argue, start early. Every penny counts, and time is your friend. Okay, the time value of money, which Ali will touch on here. Compounding is your friend. And number 3, make tough decisions. Not necessarily always the decisions you want to make as you're spending money, but you will have to make some decisions around how you're allocating money. One thing that we had chuckled a little bit about is when you think you may not have enough money to start, there could be a tough decision where today I'm going to pass on that $5 Starbucks coffee and I'm going to set that money aside perhaps into a savings account or to start to invest. So just to recap and really lay the foundation. One, what gets measured gets managed. Create that budget. In my terms, in my house, sometimes that's looked at as a bad word. So I call it a spending maximization tool, right? So you can know where your money is going and spend that to the max. Second, start early. Third, make tough decisions. Now, as we were talking about how to set up this panel, we wanted to keep it a bit more conversational. We wanted to tap into these two experts' brains and really hear what they have to offer. And we looked at it in two buckets. One, led by Ali, more so around cash flow in investing. You could also think about that as what should I be doing with my income? And second is the bucket of debt management that Don will touch on. So we'll try to bounce back and forth posing some questions. So if there's points that you want us to elaborate on, we'll try to keep some time at the end for you to be able to throw up a hand and ask questions. So please jot down any notes, and we would love that type of dialogue. I know Ali said that she loves the conversation. So with that, let's get started. Ali, when you think about broadly cash flow and investing, right? As I started to state a second ago, what should I do with my income? Really from that starting point, I mean, the question that comes to my mind is, what are recommendations about how I should handle my paycheck?
Sure. So thanks everyone for coming. I'm Allie. I'm a really conversational gal. So just want to ask a question of the audience. How many are kind of scared to look at their paycheck or their monthly income? Who's kind of scared to look at their money? Yeah. Who thinks that like, I might not have enough. Maybe I go negative in my checking account on occasion. And because of that, I'm just not going to look at it. I'm going to try to pay my bills and get by. Maybe not. So to answer that question, I used to be someone that might have been scared to look at what my monthly was. So I was like, I'll do a budget someday when I have that job. I'm going to do a budget once I get my first job out of college. That's when I'm going to start looking at it. And you end up getting into this mentality where you're always pushing the buck forward as to when you're going to accomplish these goals. So first step is let's take a look at it. Let's say you have $500 a month coming in. We'll make it really simple. I would encourage you to start out your initial budget, even just writing it down on a piece of paper and say I have $500. I'm spending $200 on my rent. I've got $100 into my checking or into my cell phone bill, and I've got $75 left over. Whatever. I mean, obviously your numbers might be larger, but starting out to understand what's going on. Then once you have your solid bills every month, how much discretionary money do you have? That's the money that you're using to go out on the weekend. That's the money you're using to go to Starbucks. That's the money that you probably aren't necessarily saving into investments right now, and start deciding how much of that net or every monthly bill money are you going to be putting towards your goals. Maybe half of it is going to be for going out to eat. Let's say you have $50 left over. I would encourage you to start thinking about buckets with your extra money from your paychecks or from whatever income source you have. Maybe it's mom and dad. And you can start funding into a retirement account and or an investment account with $10 a month. There's no requirement for minimums to start auto investing or to start opening up a Roth at Vanguard or something along those lines. So what I encourage people to do from day one, if you think you don't have enough to do this, you probably do. I bet you spend $20 at Starbucks every month. Maybe you could auto pay that $20 into some sort of Roth IRA if you have some sort of employment income or some other savings pot. Keeping in mind that establishing an emergency fund is normally goal number one, in cash at your local bank or credit union, and then investing is on top of that. So step one, looking and creating that budget, seeing how much your net is. Step two, cash for emergency funds. Step three, establishing even a small bucket into our retirement accounts and not pushing it off. You can put $5 a month into investments. It doesn't need to wait until you have that job. It doesn't need to wait 5 years until your income goes up. The earlier you start, the less amount you have to save over time. So a little bit there.
No, that's great. Question for you, just thinking ahead, because it's something that I had a discussion with my niece who was a nursing school graduate from UW Nursing School, and she had never had a finance class. And we started talking, her brother, my nephew, wanted to talk about investing and, buying Bitcoin and all this. And she was just like, I need to learn how to set up some of the different accounts.
Right.
You mentioned rainy day fund. Did anybody catch that she mentioned rainy day fund?
Mm-hmm.
I see some heads nodding. That's awesome. Can you elaborate on what you mean by that and what is that used for?
So
I think it's a very important thing where this was a new concept to a recent graduate that I was talking to.
yeah. So typically speaking, if you were to set up your finances appropriately, you'd have 3 to 6 months savings for what we'd call an emergency fund or a rainy day fund. Step one is knowing how much your monthly expenses are to know what 3 to 6 months is, and that should be your target. Usually you'd keep that in what we'd call cash or cash equivalents. So that's going to be either cash held at your bank, CDs, and on a rare occasion, money market. But I would say cash at your bank is probably step one, and your savings account is where we would hold that. And I kind of have an alternative view on should I wait to start investing until I have that emergency fund fully funded. Now, if your 3 to 6 months living expenses is, let's say, $3,000, and you don't think you'll be able to save that full $3,000 for 3 years, I wouldn't forego putting that $20 a month into your investments until you got to the $3,000. I would try to do a little bit into each pot versus waiting the 3 years if that's how long it was going to take you. But usually 3 to 6 months living expenses in cash.
Perfect. And that last piece you mentioned is, to steal your terminology, your mentality of and, not choosing an or, but an and, trying to do things in conjunction. Is that correct?
Correct. Yeah.
Okay. Awesome. Don, any other thoughts around rainy day fund, cash from a banking perspective?
Yeah, absolutely. So statistics say that 65% of Americans live paycheck to paycheck. However many dollars in, that many dollars out, and there's very little room for anything else. 40% of Americans don't have $400 saved for the next emergency. So here you are living paycheck to paycheck, and all of a sudden you need 2 new tires in your car. Has anyone bought tires recently? How much was it? $2,400. Anyone else pay less than that or more than that? Yeah. 96 per tire. So 4 tires is 400 and change, which, by the way, 40% of Americans don't have that money. So what are they going to do? This is why if you start saving now for that emergency, when that happens, you'll have $400 or $500 or whatever you're going to need, so that you don't have to do the alternative, which is what I'm going to get into when you're ready for me to get into, which is the whole lending side, or some other things that happen to people that are very expensive and not to your advantage, not to your in your best interest. And I'll get into that a little bit. I don't know if you want me to now.
Excellent. Yeah, well, let's come back to that. One thing that I would use to transition to the next question to you, Dawn, is just a quick story that we had talked about around budgeting. And we touched on it very briefly today, but Dawn and I talked about this last week. And I had the good fortune, my father was a very strong mentor in my life. And I remember when I was getting ready to go up to the University of Washington Business School, I graduated from my 2 years at TCC, excited to go up to UW Business School. And he calls me over to his house. We sit down at his kitchen table and he's like, okay, we're gonna do a budget. And I was like, okay, what's that? And just to reiterate this point of how important it is. And as we talked about at lunch, the income inputs were my Stafford loans, right? And then the expenses were all the living expenses that Ali elaborated on. And he was going to provide perhaps a little bit of money as kind of a fudge factor to make sure it footed out. But point being, that process of walking through and putting pen to paper, I mean, literally, this was my dad. He's older than me, right? Pencil to paper to spec it out. And I started telling him about, well, there's spreadsheets and this and that. And he's like, yeah, okay, we're going to just use paper right now. But going through that process and understanding that I had this income or this loan coming in at the beginning of the month, and I had to work and draw down, it really created a sense of fiscal and financial discipline. Now, my roommate up at the University of Washington, his process was very different. His parents were just like, yeah, give us a call if you need a little bit of money here and there. And once the loan money runs out. And I could overhear him time and time again, calling multiple times a week, trying to see if there was any money they could transfer to his account to help cover bills, right? And so I looked at those two scenarios, and just the simple fact, as I mentioned, starting off with that budget, understanding what levers you can pull and where your money is going was so vitally important to me. And I really took pride in the fact that I never had to call home and say, can you make up a little extra money because I spent a little too much, right? So just something that I would really hammer home, just starting off by putting together that budget and understanding what your finances look like.
Can I add to that just quickly?
Please, yeah.
So many financial institutions, including Sound Credit Union, have tools, online tools. You don't need to do paper and pencil anymore.
I still do paper every month.
Yeah, I know. But if you're Gen Z, you probably don't have to use paper and pencil anymore. No, just kidding. I have a daughter who's a junior in high school, and she started driving at 16, and you start spending money, gas, Freedom, Target runs, Taco Bell runs. All these things start when you get your wheels, right? Everyone's Freedom. So I actually did a similar thing. I said, we need to turn this tool on and let's set some budgets. Like how much do you spend on gas a month? Let's figure that out. So we put in the number, and I can't remember what it was. Let's say it was $90. How much do you eat out? Like, I hear you going to Starbucks with your friends at lunchtime. You're doing Taco Bell, Chick-fil-A runs. How much you spend in a month on that? So we set a limit. Okay. And we went through each of the things that she spends money on as a 17-year-old. Okay. And guess what? It was amazing because she checks that all the time. And she's like, wow, I didn't realize I spend that much money eating out, Dad. I go, eating out's expensive. It's very expensive. It used to be like the dollar menu, Taco Bell. I used to love that. Now you can't go in out there at under $10 or something. I mean, Starbucks coffee used to be what? How much you pay now? It's probably $6 or something, right? So I think that there's tools available to help you set limits for yourselves. And many institutions have those. I would encourage you to see if yours does and use it. Set up those budgets on there. And what happens is with the one that we have is as you begin to spend, all your bubbles are green. So you're eating out bubbles green, your gas is green. And as you spend those bubbles, some of you are shaking your head. Maybe you've seen this tool because many institutions offer this. Your bubbles turn yellow and then they turn red, meaning you've hit your limit. So it's a real easy way to look at your phone if you're out with friends and you're like, I don't know if I have them. They're all red, or I got a bunch of green bubbles. So I would just encourage you to use something, whether it's pencil, paper. The online tools are really good because as you spend money, the tool actually categorizes your expense. It knows it's eating out. It's fast food. It knows it's gas. Once in a while, you have to make a little adjustment because it doesn't quite know the vendor that you did business with, but it's very simple to fix. And then in the future, it'll always remember that one that you had to fix. Right. And so I would just encourage that as a way to create some discipline, with your spending.
Yeah, that's great. That's a much better tool than my dad's graph paper and pencil. So I like that in real time. And I'm sure they have an app for everything these days. So Dawn, if picking up from that, right? So let's say we're trying to be as financially disciplined as we can, but sometimes, right, money's going to be a little tight. I know we mentioned kind of this debt management bucket that you would take lead on. I guess I could phrase it another way is how we could potentially turn a perceived negative into a positive, right? How can we make debt work for us? So question for you is just what are some of the pros and cons of using debt and what should folks watch out for? And what are the alternatives?
I'll start off with a story. A young man named Bill who reached out to me. I believe he's 26-ish, has a full-time job, does a lot of online marketing, target marketing, what do you call it? SEO stuff, just a bunch of things like that. And he had, as you grow older and whatnot, he got a credit card. People are eager to offer you credit cards, right? Especially there used to be a day on college campuses, a couple of the big players were there trying to give every young person a credit card because they just know that it's going to become a trouble at some point in time. And that's exactly what happened. I don't believe they're allowed to be on campus anymore doing that like they used to, which is a good thing. But you still get offers for credit cards. You still see them. And this young man did. He got a credit card. He had a full-time job, but there was always things happening like new tires, different quote unquote emergencies, right? Never can make enough to get ahead, so to speak. Didn't save anything for emergencies. So when emergencies happened, he was sort of, in trouble. Like he didn't know what to do. He needs to get his brakes fixed. That's one example I remember. You need your brakes fixed, which is important to have good brakes, but you don't have the money to fix them. Credit card was maxed out. I believe it was a $5,000 credit card, which isn't that much in real life. I mean, but for him it was. So he decided he owed a couple doctors some bills. He hurt his knee skiing or snowboarding and had to go to a hospital and do this and that. And he had a couple $1,000s of hospital bills he had to pay. They were calling him, it's so annoying to get calls from people collecting. It's like, it's stressful financially. It's not a fun place to be. If you've been there, you know what I'm talking about. Anyway, so he decided to go and fix this problem. And he went to an institution, I won't even name it. You probably wouldn't know the name. Even if I did, you probably wouldn't know who it is. It's more of a finance company than, it's not a credit union, and it wasn't a bank that you'd probably recognize. And they hooked him up. And so he was calling me just to say, hey, I want to, he was very excited. I'm going to look what I did. I did this. I'm going to be able to pay the doctors off. I'm going to be able to pay this credit card off. I'm going to be able to, and I said, oh, great. I said, well, what kind of interest rate did they quote you? And he says, oh, they gave me an interest rate of 27%. I was like, really? 27%? See, you guys all moan and groan. That's not a good deal, right? Like he was just happy to get out from all under the calls, the collectors. He just wanted to find a solution. That's not where you want to be in life. You don't want to be at that position. Taking Allie's advice and Troy's advice and trying to put emergency fund. But if you have to borrow money, and a lot of people do have to borrow money. Remember, we're mostly living paycheck to paycheck. If you want to buy a car, you're probably going to have to get a loan unless you've saved the money. You could save money and buy a car. But if you're looking to buy, a couple-year-old car, in decent shape, what are you going to pay for that? What do you think? What? I didn't quite hear you. $4,000. Okay. Easily $4,000. If not 5, 6, 7, 8, it just depends because the price of cars keep going up, right? So you're going to have to get a loan if you're going to do that, unless you're really good. You have a great job and you know how to save money. So what I would encourage you to do is if you have to get a loan, look at options. Credit card is an option. Credit card is actually a good product for building your credit score if you use it the right way. Meaning you charge gas on it, you pay it off. You don't carry a balance because most people, and I even get credit card offers, okay, that are in the 20% range. It's virtually impossible to pay that off if you just pay the minimum payment. It's going to take you 15 years or something. You could run the numbers and see, the finance people here in the room, how long it would take you. If you had $5,000 on a credit card, you make that minimum payment, which is usually 1.5% of the balance. It's going to take you forever at 20-some% interest rate. I would encourage you to use credit cards to build credit score, but do it like that. If you charge gas, and I've had all my kids do that, help them get a credit card, and then they run it, they pay it off, and that helps build your credit so that when you're ready for a car loan, someday a home loan or whatever home loan you're going to need, you'll actually have credit history. The biggest thing we see when young people come in to apply for a loan is they have zero credit history. Well, the credit score is to help the lenders know how big of a risk are you to lend you the money. Are you going to pay it back? Because, in a credit union scenario, the credit union is owned by the members. When we lend member money out, we need to get the member money back. It's pretty simple. So we have to measure that risk. And the biggest way we do that is your credit score, plus your income and other things. And so there's other credit options that will help you build your credit score, that it might require some help from a parent or uncle or somebody, but there's other loans that you can do that maybe you're not aware of that will actually, in your name, the loan's in your name, and it'll actually help you build that credit score. So I would look at those options. And if you need to know more, I don't want to take up too much more time. Lending is not bad. It's sometimes a necessity, but make sure you understand what you're paying, how much you're paying, what the term is, all those kinds of things. For example, if you have a credit card loan today and someone offers you, transfer your balance to our credit card at 0% interest for 12 months. Okay. What they don't tell you sometimes, and if you read the small writing, there's a fee. And the fee could be 5%, 6%, whatever they're charging the fee. Well, if there's a 5 or 6% fee to move that money, you've in essence for 12 months, you've in essence paid 5% interest or 6% interest. They don't tell you that. It seems like it's free, it's zero. There is a fee. I would just make sure you really understand what you're getting into. This kid, Bill, even though he's not a kid anymore, he just did not really comprehend what he was getting into. And he was just about ready to sign that. And so I was able to intervene and help him find something much better that was more in his best interest and not in the best interest and not the best interest of that lender.
Ali, did you have a point on that? Yeah, please.
Can I just make one side note? So just to follow up on what Don just said about interest rates. If you had a debt that was 24, 18, and 14%, let's say you had 3 pieces of debt, which one would you pay off first? Highest rate? All right, we're going to pay off our highest rate. What if it was the lowest balance? Would you still pay it off first? Highest rate. All right, cool. So I'm looking at my debt. So number one, we know what our interest rates are on all our pieces of debt. We know high to low. Which one are we paying off first? The highest rate. Perfect. Love it. Then what if you can't make the minimum payments? What do? Do you just not make the payments? Do you just choose one of the 3 to make the payments on? So here's something I learned when I was in college. I was heavily indebted after college. I got one of those credit cards on campus, maxed it out, had a Nordstrom's card, loved clothes, maxed that out. Something happened with my car, had another loan also, so I had a bunch of debt and I was getting into the finance industry. I found out after I did my budget and I had $150 left over, I found out that I wouldn't get sent to collections even if I made a $10 payment on that piece of debt. I was like, wow, I'm not going to get sent to collections. I can just call and say, hey, I can only pay $20. They take my credit card and I made a $20 payment. I paid off all my debt by doing that. And I never once got sent to collections. And my credit score kept increasing because I was making my payments. So just an FYI, don't just stop paying. Even if you can only pay $10 on that, call up and make the $10 payment. So my 2 cents.
Just to follow up on that, I have written down here, don't run and hide. That's the worst thing you could 100%. Do. If you owe someone money and they're calling you, that's the worst thing you can do. Okay. Because it's going to hurt. It's going to hurt your credit score. They're going to find you. There's so much technology out there to hunt. It's going to be stressful for you. What most people don't know is that lenders will work with you. The best thing you can do is call them and tell them your situation and say, look, I've done my budget. I know how much I'm spending. I've cut these things out and I can afford $20 a month, but I'm going to pay you $20 a month. And then the next thing I had written down was do what you say and say what you mean. Don't agree to $20 and then not pay the $20. If you do that, you just lost the trust, right? Though if they trust you and believe you, and you do that, they're going to work with you. They know that you're going to be good for your money and they're going to work with you. Most credit unions will do that. Most local banks will do that. The problem when you go national banks, like the really big banks, it's harder to get that kind of. So if you have an account with a large national bank, that's great. They may have a good app and whatever. You're your income's going there or whatnot. But if you're going to borrow, I would consider borrowing with a smaller institution. You're going to get more attention and more forgiveness. They're going to work with you more. And so that's a great point. I mean, that's exactly what you want to do right there. And then they'll work with you.
Excellent. No, a lot of great points. And I see a lot of heads nodding out there, which is awesome. And if you think about what we've touched on so far is, and coming back to you with another question, Allie, is, paying yourself first, right? Setting up a bit of that rainy day fund, thinking about investing. We've talked about if times get a little tight and we have to look at some debt, which used appropriately can be a fantastic tool, right? If we come back to the investing side, okay, so to go a little further down that path and think about how can we start investing? What's the best way to dive into this, which might be new to folks in the room? And what type of planning and research do you do to start to put in place an investment program?
Sure. Okay. One of the things I'm seeing with my age group and younger, I'm not going to tell you how old I am, but I will say I'm not Z. But I am noticing, and myself included, I have Robinhood on my phone. I'm buying stocks on my phone. I'm transferring money, as well as I'm sure a lot of you are. I want to make a point to say that is not long-term investing. Putting money into your Robinhood account, that's not saving for your future. That's gambling essentially with individual stocks, which is fine, but it is no substitute for opening up a Roth IRA or opening up an investment account that's more diversified. So I love the fact that you got Robinhood or that you're buying crypto or that you think you can time the system. Okay, cool. I'm into it. But let's also make sure we have a more conservative investment solution here. So there's some really cool free solutions online to where you can open up your own account. You don't have to pay an advisor to do it. I would discourage people from interacting with too many financial advisors early on because you can get taken advantage of or you're paying fees that you don't need to pay. And I'm an advisor, so I'm saying that, and that means it's probably not the best idea for everyone at first, maybe down the road. So Vanguard I'm not promoting Vanguard, but Vanguard's a good example of a low cost place where you can open up your own account. And there are investment products that have been created for your first time investors. There are something called target funds that are in place that rebalance for you. So you can choose a date far off when you think you're going to be 65, whatever date that is, and it will auto invest for you. These are diversified long-term holdings that will rebalance for you without a financial advisor. You don't need to go and choose all your own individual stocks. It does it for you. So there are some options there that you can utilize. And if there's any questions at the end about types of investing, let me know. But individual stocks are not a replacement for long-term investing. Also, with a Roth IRA, there is income phase outs, but most people when they first start out will not be over that. And as long as you have some sort of employment income, you can open up a Roth IRA. That is putting post-tax money from your paycheck into a vehicle that's growing tax-free. The fact that the IRS the government hasn't shut down the Roth IRA as being the most amazing benefit to the people, I have no idea. I'm sure they will eventually, but you can still get on it now. And that means I can put $1,000 in today, and maybe when I'm 60, it's grown to $50,000, and I never pay taxes on $49,000. Amazing. So you can put, I believe, $7,000 or $7,500 a year into it if you're under 50 and a half right now, I believe. Around 7. You can auto pay $20 a month into a Roth at Vanguard into a target fund for free. So more on that later, but that's just a couple ideas to get started.
No, that's great. It's actually interesting you mentioned Vanguard. I know when I was much closer to your age than my current age, that's what I looked at, right? Because it was low to no fees or a no load type of funds. And I started off investing in a S&P 500 index fund, getting broad exposure, diversified. Wasn't as fun to talk about as like the modern day meme stocks or Bitcoin, but it was just a way to start early and allow that to just grow and get exposure to 500 different stocks. So that's fascinating.
I had something.
Yeah, please, Don.
Something to consider when you talk investing, and you kind of have to set a priority right now. Like, what's most important for me? Is it to start So for example, this person, Bill, when I was talking to him, I said, do you have any money anywhere else? He says, well, I bought some crypto. I says, well, can you cash that out? Well, no, it's not worth anything anymore. You know, if he sold it, it'd be at a loss. I don't think it was FTX, but it was some, you know, all the cryptos are. So he probably wasn't in the right position to buy crypto. He probably needed to build that emergency savings first, then buy crypto because emergency is going to happen in life. We know that. And if he would have done that, he would have avoided all this other mess that he was getting himself into. Right. So I think sometimes it's easy to jump on the new exciting thing before we're actually ready to do that. I would just contemplate, try to build that safety net first or rainy day fund you talked about before you get into some of these crypto. Now, as far as the long-term investing, that's something that I think, you know, it's safe. It's not going to, you know, it's got a proven track record over so many years, 40 years, 50 years, whatever it is. That's a different type of investing. But some of these other high risk type investments, well, if you're barely getting by month to month, how is that going to help you when you need the money? You know, so just keep that in mind.
Yeah, I think that's great, Don. I mean, the way that I bucket that in my head is looking at your risk tolerance, right? Is looking at what type of risk, what's the downside that you can weather right now based on where you're at financially. And I think that goes into how you can layer and do this and mentality of investing some for the long term, and maybe as you've built up some of that rainy day fund into more of the speculative stocks, maybe. So we've touched a little bit on investing, a little bit on use of debt. I want to drill into the debt side just a little bit more because we started talking about like Bill's example, and you piqued my interest in the way of what does he do now? So he's gotten himself into a little bit of trouble around like debt consolidation or a way to work out. Could you provide maybe a thought or two on that, Don, around what's a good way? You started to allude to maybe talking to a financial institution, but what's a good way to work yourself out if you've gotten yourself into a hole? Because it happens, right?
Yeah. So his solution was he found somebody who would be willing to not co-sign, but a co-sign is a real valid way to start your debt. If you have somebody who's willing to co-sign, not everybody has that. I get that. I remember when I came out of college, my very first car loan, I had like a good friend of mine who, you know, this was a long time ago, but he was one of the top first 15 or 20 people at a company called Word Perfect, which doesn't exist anymore, which, you know, that's how I'm dating myself. But he had money, he had assets. He said, I'll co-sign that for you. I'm like, you will? He goes, yeah, no problem. So he literally drove with me to the credit union and he co-signed my loan. That doesn't happen every day. But if a parent or uncle or aunt or grandparent, that's a great way for you to get your name on the loan and start building your credit. Now, if you do that, you better make sure you make your payments on time. Because if you don't, you just put that special person in a problem. And you don't want to do that, right? Nobody wants to do that. And so they were so kind enough to do that for you. So that's one way. And he didn't take that approach. He had a parent who was able to, I think he was looking for $5,000, and he had a parent who was willing to put $5,000 in a savings account. And it's basically, it's secured, it's locked down. So the parent can't access that money. And then the loan is secured by that. So if the loan goes bad, the institution grabs the $5,000 from the parent. Okay. So if somebody has a good chunk of savings, they don't need that $5,000. They can help somebody by doing that. It's called a share secured loan. That's the alternative. He went, and I believe his interest rate was, it was like 3% or something like that. It saved him, I think it was around $1,500 over 4 years from the original loan that's money in his pocket, not in someone else's pocket. So there's some strategies like that where you can, I read stories of how we help members at the credit union, and I hear stories of people coming in with so much in credit card debt, and they figure out that, for example, their car is almost paid off and they have a $5,000 credit card. So they use their car as collateral on that, and they pay off that credit card at 30%. and the car loan is like 5%. It's just a smarter way to use what you have, that, whether it's your car, your savings or whatever, rather than paying those high. So I would explore. I would go to a credit union or a bank and say, hey, this is my situation, and see if they can help you figure out a solution that's going to be in your best interest. And yeah.
No, that's actually fascinating. You didn't even talked about this ahead of time, but you made me remember something from when I purchased my first car. So it wasn't necessarily a way to work out of debt consolidation or being in a bad spot. It was to your other point around how do you start that credit score? And I was fortunate enough to where I was looking to get a $2,000 car loan, and my grandparents put $2,000 into a savings account. But whereas my grandma wanted to give me the money, I told my grandpa, nope, I want to earn this and I want to build this out. And my grandpa said, okay. And he searched around and made sure it was the best rate for him in a deposit account. And then it became a secured line of credit basically to me for $2,000. And that got me started on my auto loan. And from there, built out the credit score. Interesting, you can also use that for a way to work out of a debt issue. So probably the suggestion there is just work with your financial institution, ask questions and research, right? To try to find different options around debt consolidation.
Yeah, I would say there's a lot of providers. There's a lot of people out like SoFi, a lot of companies, fintechs, right? Online companies that will be happy to give you money. The question is, how much am I gonna have to pay you back? And is there a better way? Should I look at the SoFi loan, the debt consolidation loan through SoFi at 12, 15%, whatever it is? Maybe it's 9, I don't know, it depends on your situation. Maybe I should do that and see what that is, but then maybe I should go at least talk to one credit union and see what could they do, and then compare. The problem I think is people just, those systems are set up so easy to just boom, you hit that button and that money's in your account. It's very tempting to go through that and actually do it without really checking, managing. You said the first thing you have to do is measure and to manage. How does that compare to my other options? I avoid that quick urge to get that quick money in your account. It may turn out to be the best deal for you. And if it is, great. But my guess is you may find something better for you. Yeah.
Well, for the sake of time, we wanted to save a little bit for questions. So hopefully you've been thinking through items you want to ask the panel here. But I wanted to close with just a couple of thoughts and going back to kind of where we began, right? So as you start this journey of financial wellness and fiscal management, is that the tenets that I started with, right? Is that what gets measured gets managed. So start that budget, start looking at where you're spending the money. Start early, as we talked about a little bit on compounding, and that time is your friend. And also make sure you can make some of those tough decisions, and not to bash Starbucks, but maybe that Starbucks coffee gets put on delay. The other key points that I think we hit on today, which were fascinating, so I thank you both for all of your insight and wisdom, is when you're thinking about starting on this endeavor is, pay yourself first. Right? We didn't even get into if you get a job where there is corporate matching and some type of retirement plan. We didn't even get into that. But set up that rainy day fund, right? Start putting some money aside for the emergency by paying yourself first. Staying the course, number 2. So the financial markets go up and down, but over the long run, equity markets have tended to trend up. So even if the markets are a little shaky, stay the course, continue your investment program, because in the long run, that can pay off. Touched a little bit about managing your credit score. Keep an eye on your credit score. And I love your phrase down my final point is don't run and hide. So I'm going to steal that. Don't run and hide. If you do get yourself into a jam, a little bit with debt or with a financial institution, reach out to them, have a conversation, and work through some type of loan repayment program. So I'm going to pause there, and please, with just a show of hands, if you guys have a question for our experts, please just raise your hand. And excellent, in the back.
All right, I'll try to yell this, but thank you for coming here. I believe this is the finance event of the year. I'm a first-year student here at UW Tacoma. I love finance. That is my thing. So what exactly do you suggest someone do when they have net income, strong cash flow, How do you safely use leverage to build wealth?
So when we say net income, strong cash flow and using leverage, do we already have fully maxed out retirement accounts?
Yes, so 6,500 in the Roth IRA.
And then if there's an employer that's creating this net healthy income, is there a fully maxed out 401k?
42,500.
Oh, look at you, research. I think it depends on where your goals are at that point. So if you have your fully maxed out 401k, 403b every year, fully maxed out IRA, or Roth conversion, depending on your AGI, I would then start exploring other investments, whether that be you want to get into having real estate property that's some days income producing that you're paying off. Love that idea, especially if you have 30 years before it's paid off. Great supplement to Social Security. We might not have it. You probably don't have a pension at this day and age. So rental properties are great pension creators. As for investment leverage, honestly, I try not to get into investment leverage and investment accounts unless it's an investor that probably has at least 2 to 3 million of assets already invested prior to using investment leverage. If we're talking about investment related leverage, prior to that, I would probably just promote an additional investment account on top of the already existing retirement savings. And then if taxes are a consideration, potentially utilizing municipal bond funds or individual municipal bonds.
Thank you.
Yep.
One last question because I want to be serious, but this is
Awesome. Yay, we need more CFPs. We're a dying breed.
So the reason why I was asking about leverage is because what's to say that America is going to be #1 and that the S&P 500 will go up? So like the way I see it,
Yeah.
how can we use debt in our favor to build wealth, to share that wealth and build a community?
Sure. I don't know if the S&P going up or not up is correlated with leverage necessarily, but point one on, we don't know the S&P is going to go up. The S&P is U.S. large companies, let's say, for those who don't know what that is. We promote diversified investing, so not just the S&P 500, which includes international, emerging markets, international bonds, et cetera. So you are using leverage in a way with your bond funds, both domestic and international. And I don't know, Troy, if you want to go deeper on leverage, I can't really speak to leverage beyond that.
I wouldn't be in a good position to do that.
Yeah, it's just not, to be fair, like beyond what I've talked about, and I deal with mainly investors in the $1 to $10 million space. I would say leverage isn't really used in a major way. So if we're talking leverage on investments in a big way, it's either someone's passion project where they've got an interest in said leverage, so they're utilizing it, or they're an intelligent investor, they're doing some sort of collaboration with startup or things of that nature, but you're going to be really getting into a specific niche. And so you're going to want to find an advisor that's kind of correlated with that niche.
This is just a comment, but like I waited 7 months to ask this.
Yeah.
Also, the reason why I bring up leverage, why aren't you telling everyone here to buy real estate? Because
Well, that's one asset class, so it's not very diversified for that to be your only piece. Yeah. Yeah. Sure. Yeah, absolutely. Yeah. I just think that maybe for this particular audience, I don't really think that people are, maybe not even purchased their own first house yet. So I don't know if real estate as an investment is for this particular seminar, but I do think it's a great topic for future discussions. Yeah. Yeah, no, it sounds like great topics for a real estate focused investment session. Yeah, awesome. Thank you so much. Great comments.
Any other questions, please?
Quick question.
Sure.
I was wondering, how much we can have, as a percent invested in, a taxable account rather than our retirement account?
I go full retirement first. I really don't do taxable accounts until we're fully maxed out on our retirement savings. That's always number one after your emergency fund personally. If you want to allocate a little percentage into an investment account because you want some more medium term to short term investment money, meaning 3 years to 10 to 15, let's say, that medium term, then maybe you want to put some in taxable for goals. Like, I know I want to buy a house in 5 years type of medium term. Yep.
Yes, please.
My question is, how do I get credit score without taking a loan?
How do I get a credit score without taking a loan?
You don't. You have to get a loan. So I think I described the easiest way to do that is to get a credit card, but make sure you pay it off all the time. Then you'll start to build your credit score. And then some people will actually get a car loan. They'll just so they can help build their credit score. They may not need the loan, but they'll do that for a period of time, then they pay it off. But at least now you have a line of credit on your credit score. And the more lines you have and the more you pay them on time, the better your credit score is going to be.
Is it most critical way to get out of it?
Can you say that again?
Is it the most critical way to get out and move forward, right? You know, so you need to get a loan to get a credit score. You get a credit score.
Yeah, what comes first, the chicken or the egg, right? Yeah. In this case, the loan comes first to get it. If you don't have a loan and you apply for a loan, you're going to have what's called a thin credit, which means you don't have any credit. So someone's going to take a chance on you without any really history, how you've handled your credit.
But maybe to that point, a way to ease into that is via a credit card, right? With a very small limit, making small purchases like gas, like you use the analogy with your daughter, correct? So, even if it's not a full loan qualification, it's a card to start. I think the key thing is pay it off every month, right?
There are some schools of thought that say that you need a small balance to go month over month, at least every so often. So if you have $1,000 and you pay off $950 and you let $50 go over, there are some schools of thought that say that will build it faster if you have a little bit of revolving. Versus the payoff every month. I've heard that. They don't actually produce and tell you what the actual methodology is for credit scores. It's all a little bit of conjecture.
Looks like we can sneak in one more question here in front, please.
What does interledger protocol mean for my future of month?
What that means.
I'm not sure.
So like Bitcoin, for example. Like distributed ledger technology.
So you're talking about blockchain technology, right?
Okay.
Which is what all Bitcoin is basically built on. Now, what's your question about that?
So it seems like this kind of technology is here to stay, right?
Yep.
It's not going anywhere. It's probably going to be used by somebody. My question is, how could somebody use that to fully change, maybe not fully change, but to change the way money works?
I could answer that question. We're actually going to have a blockchain course in May of this year. We're in the process of actually planning that. It's going to be a 2-hour session. We haven't actually targeted a date yet. And so I encourage you to sign up for that. And then we'll also be recording that event as well to be available later on. And so I just want to thank Troy, Ali, and Dawn for being here today. This was a fascinating discussion. Yes, thank you.